Well, thank you very much for everyone for joining. I've got myself, Dave, and Andrew here, and we're going to go through a bunch of questions that came in from our end of quarter. We're going to touch on all the asset classes that we are currently working in. And then we have some general financial overview questions that we're going to touch base on. One of those first ones, end of the year, is always, okay, the reports are out. When are our taxes going to be done? And when are we going to get our K1s?
Right. And a lot of times it's very polite when people ask, and sometimes
it's kind of like,
it's not so
how
polite.
fast can we get these done?
Yes, I need it now, please.
You know, each year when we go through our K1 process, the IRS will release what the K1 form is for the year. Last year, that form was a little bit delayed in 2021. 2022, the IRS K1 forms are out, and we are wrapping up our taxes now. Our goal is to have all of these out by the end of February here. They're due March 15th. So if you have any K1s you're supposed to receive, you're supposed to get all that stuff by March 15th. But we plan to have all that done by the end of February. And you'll get email notifications with them. And then all of that stuff will be posted in the Juniper portal for investors as well.
Great.
Yeah. So next question here is,
so distributions. I'm always wondering, when am I going to get my distributions? And distributions usually come the 20th, or actually we do a pretty good job of getting them to the 20th of the following month after the quarter ends. And the quarter, our fiscal quarter does end the 25th of every month. And so you'll notice that sometimes that the actual payment is dated the 25th, but is actually paid the 20th of the following month.
right.
And really that's because we have to do the accounting close. We have to check everything. We have to go through all of our financials and make sure everything's accurate. But we're essentially paying as if the profitability or the clock stopped ticking on the 25th. So we pay everything based on that date.
And that's why you see the 25th in the investor portal.
Right.
So for our fourth quarter distributions, you see December 25th as the date. And then, yeah, you'll get them. I mean, everyone should have everything by now because it went out on the 20th.
Right. Yes. So how are prefs paid, and how do the calculations work when you're
yeah, so we
quarter?
In our statements, we have this pref paid year to date and pref due year to date. And we really do that while it's each quarter, we're doing that on a per day basis for the year. So some quarters have 90 or 91 days in there, but it's a daily rate that we post in there on the pref due amount. And the pref paid is just anything that we have paid for the year goes into that section of our cover page.
So possibly prefs might have been short for maybe Q2, but then they were made up in Q3 and Q4. And so for the entire year, they'll show us paid, but maybe Q2 showed it was a little short.
Correct.
Okay.
And then you can see that next to that pref due, there's a percentage calculation that shows like what percentage was paid. If our pref is 7% and we paid out a little bit less, it might say 6.1%, 7.3%. It'll show you the calculation on there as well.
Yeah, I believe there's a lifetime pref calculation on their sheet too. Yes.
Yep.
Okay. So given interest rates right now, what are we doing with the extra cash?
Yeah, well, we have two banks that are working with us right now. Any of the deals we have funds that are in multiple banks at any given time based on who the lender is. Typically, a lender will require us to have our operating accounts with them. That doesn't necessarily mean they pay us interest on those operating accounts. But the reserve accounts we do have, those we're earning about 3% interest on those right now. And even our money market accounts, we have all of our retail.
And I remember some $600 a month where we're getting $600 of free money and interest because just of our reserve accounts. And that's not a lot of money, but it's free, $600 a month, free money. So.
Yeah. And then we have that at all of our commercial assets. Those are the ones that have the bulk of our reserves. Our residential assets they have some reserves, but most of that is taxes and insurance. And we're kind of paying out any cash flow above that. The commercial side, we're building longer term reserves there as it relates to upcoming leasing commissions or upcoming TI that we're planning for. An example of that is TVTC, where we have almost $1 million of cash. In those cases, though, some of that cash is held at the lender and some of it is held on our own books. Now, our lender reserves are not receiving that 3% rate.
But $1 million of cash, I'm just doing the math in my head right now. It's about,
Yeah, but almost 600 of that is held at the lender.
oh, and they don't pay you interest on that.
The lenders, when we do, any of our bigger banks, or we have Fannie and Freddie loans, when they hold our reserves, they're not paying us market rate interest on those. We're getting a little bit, like 25 points or 1/4% or 0.5%. So we get a very minor component of what interest could be earned there. I'm sure it's great for them.
I was just thinking they're using that money to make more loans to other people. Well, maybe
Yeah.
us too.
But we don't earn anything on those. It's that kind of, quite frankly, that sucks for us that money is required to be there and we can't earn interest on it. Two of the bank relationships we have, we started them about 4 years ago, where it was like, look, they will give us interest on our deposits, and that's why we have our money there. So the bulk of our deposits are earning 3% if we have that control.
Right. Oh, and even a little bit of a tangent, but the new banks we're going with right now don't charge us fees. So essentially we keep enough deposits there. So we're earning interest, and they're essentially free checking accounts. So all the operating accounts that we operate, a lot of them are free at least.
Yeah, we have some of our older legacy banks do charge hefty fees on
Yeah.
accounts. So we're moving away from a no interest charge fees to no fee earn interest.
Yeah.
So it's a good
You
spread.
just moved a bunch of accounts because we were giving feed.
Yeah, we're getting feed to death on some of that
feed to
stuff.
death, yeah.
Okay, so next question that we got in from the end of quarter is, what are the mortgage rates or debt rates that we're currently seeing? And these certainly vary across the types of assets that we have.
Yeah, and banks, because banks typically are not giving us as competitive rates right now as credit unions. We love our credit unions. We love a couple of our credit union lenders. They're always giving us great debt.
Yeah.
In fact, we just got one quoted at an unheard of 5.8, which we have not
Unheard
seen.
of.
Yeah, unheard
Yes.
of. But typically right now, banks are quoting us in the 7s. And then we're getting credit unions to quote us in the 6s and even maybe in the high 5s. But for retail, I think our lowest has been 5.85, and then the highest has been, I think our highest has been 7.5.
Yeah.
Office is roughly that same range, although office is a little bit higher at 7 to 8%. And then flex, we're also getting similar deals as retail, because I think we actually got a high 5s and flex deal.
Yeah, we recently got a
too.
high 5s, and then mostly like mid 6.
Yeah.
Mid to low 6 is where we're at with flex right now.
And the credit unions typically are a lot more competitive than a lot of the banks
Yeah,
we
and
use.
we use two forms there. We use the direct credit union, and then we're also using the credit union aggregators that
Yeah.
are, they function as the lending resource for numerous credit unions in one, sometimes a pool of 50, 100 credit unions that they are facilitating the lending for those institutions.
All right. So I don't want to put you on the spot with this one right now, but last year we were getting debt at 3 and 4% pretty regularly. But so how are we doing deals now with these higher rates?
Yeah, no, it's a good point where the deals we are finding, the cash flow on them has to be much higher to facilitate a higher debt payment, meet our investor returns that come out of each of them. So while we look at, what's going on in the market, the few deals that we have been able to find, the cash flow that they're spitting off supports the higher debt payment, and they're going to do pretty well.
So really, we're not buying deals that don't work. And because of the economics of interest rates right now, our pool of deals has shrank a little bit because prices are not adjusted with the market. We're waiting for that big adjustment right now, but that adjustment,
it's not there now.
it's not there.
Yeah.
Yeah.
So we got one question in here, like, why would we accept 3% interest? We're getting about 3.5% on our money market accounts, and we're allowed to move that money in and out however we need it, versus if we go into a treasury market and we're going to actively trade treasuries across, 40 different assets that have reserves, or 50 different assets, it's going to be a lot more to actively manage those trades and those investments. And if we can just open maybe see if it's a good point, like, can we just open money market funds at like a Vanguard with all of our different entities? It's like,
Banks would be
possibly,
they would be very unhappy about that though.
yeah, we are supposed to be keeping our cash at the banks. So
some of them it's a requirement. So it's a requirement of our loan documents that we actually keep the money with them. So technically
Yeah.
we just,
but we could probably do it with some form of them. some amount of it, if as long as we had an amount they were happy with at the bank.
Right.
So we've run into some of those types of issues if we're going to say, hey, we're going to move this money out of a bank that we're operating with. Right. Really, our push has been, how can we get those banks on board with paying us the highest money market rate that we can get for having our funds there.
So how about the next question for you? But closing fees, so closing fees on a refinance. Can you kind of summarize that for us?
We had a question on this, like, why are our fees so expensive when we did a recent refinance on the Grove, which is a deal we have in Greenville. That's an apartment deal. So we're going to go into some of the apartment questions that we have right now. And I think we're seeing this fee structure not only applies to our loans, but it also applies when we look at commercial leasing, and we'll talk about that some. But the fees used to be, if we would rewind 2-3 years ago, maybe more, they were pretty negotiable, where we could get banks to adjust their fee schedule, or sometimes brokers to adjust their fee schedule on stuff. But right now, we're essentially seeing a 1% bank fee on all originations. They call that an origination fee. And we're seeing a 1% fee to the broker that helps us place the debt. So we're seeing those 2 points all the time. And then we are paying, we have our side attorney for every closing, and then we have the lender side attorney for every closing as well.
Yeah, and this is not a profit center for Greenleaf in any way whatsoever. I mean,
all that stuff's, we're paying those fees out. We're pretty sensitive with the lender. Like, what are the lender's attorneys? We have, on our side, we get to pick our attorney. So we know what our fees could be, but we've worked with some banks where their lender fees were 3-4 times what their lender attorney fees.
And then that's when we tell the lender, we forbid you from ever using this attorney ever again.
Yeah, like some of them are just really expensive.
Yes, we had one lender who came in like 3 times higher on a retail deal than any other lender. And literally the lender went back to their attorney, and said, "This is ridiculous. You can't charge us this." And it was
and they'll bring it down in some cases,
but they don't bring it down like 50%.
Yeah, we're still paying a significant amount for legal costs.
Literally like less than 30% of that fee actually goes to Greenleaf. It actually goes outside of Greenleaf.
So that's like 2.4% on almost any loan. About 2.4% is our cost to close with our lenders and bankers that we're getting there. So that could be negotiated better a couple of years ago, and now it's pretty much every institution we were looking at has those 1% and 1% fees.
It's a lot of, we both know it's a lot of work to refinance a loan. It's a lot of maintenance. It's a lot of payroll. It's a lot of people.
We have some of our commercial loans outside. It's kind of in the apartment space, but outside of the apartment space in the commercial, if we keep a loan with that current lender, sometimes they will not charge us a new origination loan. We're kind of rolling that loan and extending it. We've had some of those this year where they didn't do that.
Right, there was a Zaxby's we just refinanced lately that they just literally did a loan modification on it because we went with the same bank. So it was a lot easier.
We did it with one of our medical deals too, where they said, okay, well, we're going to extend the term here.
Yeah.
Kept the rate fixed.
And so literally it's a piece of paper rather than a whole new loan. It's just a loan modification document.
So that was good.
Yeah. So West Side Crossing and evictions.
Yeah, evictions have been a challenge now since COVID, since March of 2020. And, if we think about this, I guess the question here is really like, how do we have evictions that have taken 16 months? And yes, it's frustratingly long.
And we're not living in New York or New Jersey.
Correct.
Yes, but we still have these.
It could be even longer in those municipalities. Seattle's exceptionally long right now. But basically what's happened, even here in Atlanta, can't necessarily speak for those other markets. They have other stuff happening, but we had no evictions for so long that now the kind of floodgates on evictions opened, and the divisions within our county and city governments that are handling evictions, it's not like they got more people to help process that workload. They basically weren't able to do anything for a year, and they said, hey, now we want you to do twice as much work in a year, and it's just not happening. So
but we did we had some income from those. There was some forgiveness. We actually got some money from, I guess it was one of the programs, the COVID programs.
We were able to file for assistance on some of this stuff,
right?
But nowhere near the year plus delay of time that they have. And that tenant, if they were doing that, they had to willingly complete those forms with us and then catch up on payments. We did have a lot of tenants that did that.
Yeah. And then there's,
But these ones are residents that are saying, hey, we do not plan to pay. They're going to fight. They're going to fight the
Yeah.
eviction and they're going to hold on as long
I
as they
think the
can.
word is, those are called professional tenants.
So yeah, that's been a struggle. I mean, West Side Crossing right now is our biggest struggle with long-term non-paying residents. And we're looking at about 6 to 9 months for any new evictions that are coming out.
So with all of these, you know, the interest rate changes and obviously when an interest rate goes up, in theory, the property value may be adjusted too. So what's happening in the residential space with the interest rates going up?
We're definitely seeing some rising of cap rates in the apartment space, residential. You know, they were coming off points of cap rates that are like 3 or 4%. And
Chick-fil-A.
now, yes, Chick-fil-A, but you know, if we're looking at cap rates at around a 5% for the type of apartments that we own, that's really what we're seeing in the market. We've adjusted some of our values on our statements to show this between 5.5% cap rates. And the other part with that is we're adjusting our valuations every quarter. So depending on what the net income does for that quarter, it's going to move our valuations higher or lower. So if we have an expensive quarter with opex, it's going to reduce our net income and it's going to lower our value. So we're going to keep adjusting those every quarter, just kind of stay in tune with where things are.
And so how are rental with the changing market, inflation, what's happening with rental rates right now over the past?
Yeah, I mean, on
quarters?
the apartment side, we talked about this some in our end of quarter stuff. We've still seen significant rental rate growth. It's been very good. And our margins are expanding on the apartment side because our revenue growth is still outpacing expenses significantly. So that part has been doing very well.
It's good. It's good.
Yeah. So we're going to dive in to retail questions.
My favorite.
Your
favorite topic.
favorite?
Yes, my favorite.
All right. So first kind of questions that came here is how are our retail properties performing compared to the original pro formas?
I'd say overall, we're doing really well. We're paying prefs on like last quarter. I think we paid prefs on every single property. I think there was one property that maybe paid 85% of prefs, and a lot of the others are paying the full pref plus profits. So we're doing pretty well. And the distributions to investors are still doing remarkably. We're about 10% of Greenleaf's revenue right now, but paying about 30% of the investor distribution. So it's a good reliable payer.
We've got 18 retail deals
Yes.
right now that all have made distributions in the fourth quarter. They all made distributions throughout the year.
And we had 2 sales the end of last year too, which did remarkably well. They were both, I think, close to about 30% overall return. So those did pretty good. So I think, you know, overall the retail portfolio it's not a sexy portfolio, but it's a reliable payer, and it does, you know, it's more predictable. There's less, since essentially the risk has been pushed to the tenant, the risk for us is a little bit more limited.
So we look at these deals. We had a question come in about, are we looking at selling any of them in the retail side?
Yeah, this is a long conversation, but you know, we are always looking at selling. So we're doing our portfolio analysis right now of what we're selling. And typically right now, you and I had a long discussion about this, but it's anything that's high touch. So anything that requires a lot of people, a lot of time, or a lot of effort.
Which is relative in the retail space.
Which is relative, yes.
But yes.
So if one property takes 10 hours or 20 hours a month to manage, and one property takes an hour a month to manage, which one do we want to keep? We want to keep one that takes 1 hour and the one that's taking 20 hours of our time. You know, if it's arguably making the same amount of money, we should probably look at disposing of that asset and selling it. So
if we look at the value creation, it's always highest right when we sign these leases.
Yes. Yes. In fact, all of our dispositions have been, not literally, I'm going to say this a little sarcastically, but the day after we get the lease extension, it's on the market for sale.
The immediate next step.
Yeah, the immediate next step is to sell.
Lease,
so our $2 Generals, we got the lease extension, we sold them. Our Applebee's Duluth last year, we got the lease extension, sold it. So that's typically the plan, and that's how we're making the most money. And honestly, we'll look at some other lease extensions, and once we get that lease extension for whatever property, it will be listed for sale, because that's going to be the maximum value achieved for that asset, because every year that lease burns off, theory, it's worth a little bit less money.
Right, each time. And I think that same strategy relates directly to, I mean, if we were to back it up to apartments, we're just talking about, like, once we gain higher occupancy, we have a better rent roll. That's when the asset is really created that value and we could look to exit it. On the apartment side, we are, we're looking at some deals. It was like, does it make more sense to exit these right now?
Well, at
And
100%
that's-
occupancy apartment complex is a nice deal to sell, I'm assuming.
Yeah.
Yeah.
So there we're looking at Rosecroft and West Side Crossing are two that they're well occupied. Oh, obviously we mentioned our eviction struggles we're having at West Side Crossing,
High touch.
but high touch and challenges
Yeah.
that we would look to exit and just take our gains that we have there. All right, so
we'll
let's-
talk about the commercial portfolio.
Yeah, commercial. And these, obviously we've grown our commercial portfolio a bunch in the past 3 years. And, we're kind of always learning and going through how do we present information within this space. And one of the questions that came in is when we have a stable tenant, how does our operating expenses change so significantly? And two deals specifically in question were Johnson Square and Parsons, because in these cases, their operating costs were significantly higher than what was budgeted or what was in our pro forma. And when we're thinking about how we present our commercial assets, we have really 3 expense buckets. We have our operating costs, which we call controllable operating costs. And in us, that's kind of a unique to Greenleaf term. We call everything controllable that we can alter the outcome of. The things that we can't alter the outcome of are called non-controllable.
Taxes.
And that's taxes and insurance.
Yeah.
So those are non-controllable. Everything else, we feel like we can get our hands on that. We can move the numbers so we have an impact. We call that controllable. Our management philosophy with that, our teams are bonused on income minus controllable expenses. So that's where because they live in that spot. When we look at our commercial deals, we added this other segment that's called our reserves. And we've talked a lot over the years about reserves and what we're trying to do and make sure we have a cushion. I mentioned TVTC having $1 million. So it has a lot of reserves. But when we spend those dollars in scenarios like Johnson Square or Parsons, we are spending money and that's hitting our operating costs. With Johnson Square, we spent about $120,000 in 2022 on leasing commissions and TI buildouts. On Parsons Meadow, we look at there's almost 100, the question came in like, hey, there's $100,000 of cost overruns and what's causing that? So I want to go through what that will look like on Parsons, because here we had an operating goal, controllable operating expenses of $172,000 for the year for 2022. And we came in at $240,000 for the year. So it's like, what the heck happened? You're way off on your costs.
Right.
But with that overage, we had budgeted $72,000 in reserves for last year, which was year 2 in our hold policy of that. And within that, we're going to spend $55,000 on tenant improvements, $10,000 on leasing, and $8,000 on CapEx. And we kind of guessed these amounts.
These are all investments for the future, and these will
Right.
bring additional revenue in future years.
And we may spend it that year or we may not.
Right.
So we put it in there for every year at Parsons that we estimate around $70,000.
So when you're paying a leasing commission, you're paying a leasing commission because you just rented that place for 5 years possibly. And the income from that 5 years is going to essentially be a very small percentage of that expense in first
Right.
year. Yeah.
So last year at Parsons, we spent $20,000 on leasing commissions. We spent $30,000 on interior improvements like HVACs and build outs related to leases. So yes, and all of that stuff gets expensed currently and hits our controllable operating expenses, but we budget for it in reserves. So we look at our pro formas, we're moving things from our reserve line and it's getting expensed in the controllable operating expense line. We do not capitalize these items. So our leasing commissions, we were just talking about this, like we pay those out currently when they're due. Our typical leasing commission is 4% plus 1 month's rent.
Right. In theory, it's almost a 5-year expense, but that 5-year expense is done in the first year. And
Yeah, I mean, it benefits us in that we get that, no matter what, we have to spend the cash in the first year.
right, the cash is gone, and then you could kind of allocate it over 5 years, but you don't want to do that. You want to expense it in the first year to have that expense now and to offset income and to offset taxes, and it just
Yeah.
works.
So it increases our expenses, reduces our taxable income.
Yeah.
But it's also, it matches to when we spent it.
But then
Right.
the first world problem is next year, our income is going to be improved because we have a better rent, we have more tenants, and
Yeah.
Yeah.
And we do definitely have to do a better job of showing what portion of our controllable operating expenses were related to a reserve spend or money that was targeted for reserves. So when we look at our statements for next quarter, in the top left corner of our statements, we show what our budget is for the year. In that segment, we're going to show what our budgeted reserve spend is for the year. And then we're also going to outline, what have we spent against these reserve dollars that hit operating costs. So we're going to try and do a better job of presenting that transparency and making it understood. The same kind of question came in for Park Lane, which this is a medical complex we own right here in Atlanta. And the question was the same. It was like, hey, our revenue looked great. It was higher than planned, but our operating expenses were $150,000 higher than planned. What the heck is going on? And while we put that in our reports of saying like, hey, we signed these leases and we were excited about it, what we didn't do a good job of was saying, look, we signed 4 leases at Park Lane in the past 2 quarters that encompass over 50% of the space that is there. And we signed them to 5 and 7-year extensions. We got rental rates in the high 20s. So these are excellent leases, all with medical tenants. We signed Peachtree Orthopedics to a 5-year deal. We signed a children's dentistry to a 5-year deal. We have a family medicine office, also 5 years, and an eye care center that we signed out 7 years. So
pretty good.
Yeah, these are all big leases.
Yeah.
And with that, we had almost $150,000 in commissions and TI that went to those 4 tenants that were all paid at the end of this year. All came out of our reserve buckets, but went to our operating
Went
expenses.
from the balance sheet essentially to the profit and loss statement.
Yeah. So one, I mean, we appreciate the questions. It was good for us to go look through that stuff and help provide some answers there. And for those, we'll send those out to you as well, just so each investor has those. But then our takeaway is doing a better job presenting what expenses came out of our reserve dollars each quarter and annually to show where that money went. So another question we had on the commercial side was Johnson Square. And the question was, where did we end up on our capital improvements? So this project, when we bought this 2 years ago,
All right.
It's like over 2 years ago, it was 68% occupied when we bought it. We're up to the mid 80s now.
Pretty good.
It's going well. We spent $1.4 million on improvements here. So we did windows, we painted the outside, we replaced the roofs, we did almost $100,000 worth of HVAC work. And then we spent $400,000 on tenant improvements for new leases that we've put in there. Even after that, we still have around $700,000 in reserves, but this is not, one of the questions like, is this reserve funds, are they going to be released? And that's not the case at Johnson Square. We're going to keep building our reserves there. We do have additional occupancy that we can add and space to lease. So we're going to keep going down that path. And we think we can improve occupancy even further. From a distributions standpoint, we paid out partial prefs in the year 2, and that was in line with our pro forma. And we expect year 3, as we're now approaching our full pro forma occupancy, to pay out all of our prefs.
So on the other property, Covington Flex, is it a similar story? Reserves and expenses. We leased other property. We leased.
Yeah, we've
more
done.
people.
Yep.
We've had to pay leasing commissions, and we've had to do some, obviously, capital improvements to actually.
Yeah, and
space.
our biggest thing there was cleaning up a lot of our flex deals that we go into, like Covington or like a top-notch flex. We are looking at repairing the parking lots and the access points. These all have large trucks. They got a lot of movement, and that wear and tear in the parking lot is real. So fixing that stuff helps. That's the bulk of what we had planned for.
Well,
at
and that's
Covington
usually why people want to sell their.
Yeah,
Because they don't wanna
repairs
do
are
it.
harder. They don't want to spend the money
Yeah,
to fix that
Because
stuff.
they can't bill the tenant for a new parking lot. They would have to get a loan
Yeah.
or they'd have to
Yeah, that's
capitalize the
correct.
whole
Yeah,
thing. So
that's
it's like,
not,
do I sell it or do I fix the parking lot? So those are the decisions a lot of people make.
Yeah, so Covington, we plan to fix the parking lot, and we have, we did fix the parking lot, but we also have funds there reserved for TI and leasing commission. So
Yeah, and quite frankly, we get to fix the parking lot with 35% of the actual cost because we would finance, in theory, 65% of the cost with our loan.
yeah, when you look at the total deal, yeah. So, another question we have is Midtown Office Park. So this is the largest square footage deal we bought that we have, and it's got a mix of all sorts of different tenant types. One, we just moved in our city of Chattanooga there, which we're excited about. They start paying rent in February. That was a big deal for us. But the other part of the question that came in is, are we still looking to parcel off some of the individual tenants here? And the answer to that is yes, we plan to do that this year. We have some medical and some net lease tenants there that we plan to dispose of this quarter, because we think from the basis that we bought them, and we can sell them for significantly more, and that market is still doing very well, right? Especially, if we look at assets like maybe like 1 to 3 million on the net lease side, haven't really seen a lot of cap rate increases yet.
Right, because
Most of that's cash buyers.
right. When $1 million Dollar General is going to sell a lot easier than a $3 million deal or a $5 million deal, because the investor is typically going to pay cash for that. And when you're paying cash for it, you don't care about debt rates. So if you don't care about debt rates, arguably the cap rate is not going to change as much, because right now what we're seeing in the market is like a cap rate for a $1 million Dollar General has changed less than, say, a $4 million strip mall. So that $4 million strip mall might have had a 100-point change, whereas the $1 million Dollar General may have had a 20 or a 30-point change in cap rate.
Yeah. So our main one we have here is an eye care center. That is a single tenant. It's a medical lease.
Yeah, and I'm assuming that's going to be less than the 4 million or 3
Oh, yeah,
million.
yeah,
So it could
yeah.
be a cash buyer who is just really looking at a cash price versus the debt price.
Yeah, I think, we plan to take that out here. We want to hit our 12-month part, so it's long-term capital gains.
Right.
So we're conscious of that part of it, but we definitely plan to exit or list that stuff and try and realize some of the value we think we have in the deal in the near term. Okay, I think that is all of our questions. When we have
No more questions?
Yeah. Do we have anything else that's coming through? No? Okay. Well, we'll stick around for a tiny bit here. That's kind of the main points that we saw on each of our asset classes that came through, and some of the stuff just on the overall, like getting our K1s in and how our distributions work and stuff. Those are helpful questions. K1s are always fun as we kind of wrap up the year, finish our tax returns, and see what that information looks like. So,
Do you have any plugs for our future events up?
Future events. So yeah, we're doing an investor roundtable discussion on February 8th, which I think is going to be pretty exciting. That's an opportunity where our investors or really anyone that we know can come. And we have 4 other general partners that do work a little bit like Greenleaf, one in the hotel space, another one in the self-storage space, and another in the industrial, larger scale industrial. Think,
and we have some
500,000 square foot warehouses. We can fit all of our properties in one of their buildings.
And we have some surprise fun too that will keep the mystery.
Surprise fun, but I think that'll be a great event. So, this is a good question here. So, what's going on with the sales or purchases in the QOZ fund? So, the QOZ fund, we sold Heritage, so we have still cash on the sidelines from the sale of Heritage, which was an apartment building. We are under contract to sell 1500 North Graham, which is up in Charlotte. And that is a 23,000 square foot single building that we divided up. And we have one owner operator that is under contract in their due diligence period to purchase that one. And we had a previous buyer who backed out. So we've been under contract with this thing since like August of 2022. So we have not leased anything there. Really looking for this owner occupier to close it and take it. So we're selling for right around 5.9 million on that deal, which is about $240 a square foot. So that's going to be a good one
Sounds
for
like
us. I mean, it brings cash into the QOZ fund, which we have to then redeploy into other QOZ assets. But we're going to have a good gain there. So we're going to take that. And the Lupton, the Lupton in the QOZ has been the kind of the one that keeps going forever. But we switched our GC there. We put some of this stuff in the cover page there, but we are assessing whether we're going to exit that one or lease it. We've got some leasing interest, but we have to get our CO before we can really do anything there. The other two apartment buildings that we still have in the QOZ, we plan on holding. We have long-term debt. That's the Grove and Fairway. And Fairway has partial ownership with some fresh equity. That made a distribution this quarter. And then it also obviously distributed a little bit of money up to the QOZ fund. So that's kind of where we're at. The dispositions, we expect North Graham to sell here in the right at the end of the first quarter. So that's what we're hoping for on that front. Well, yeah, February 8th, I mean, we're going to have a couple other sponsors that are here talking about their different asset classes, which I think will be helpful and provide investors with some opportunities to look at what we're doing. From back on the QOZ, like what could we purchase and how long do we have? Those timelines all got extended from COVID for how long you have to deploy your QOZ cash. And we have a year to deploy it, but obviously we don't want to just sit there on cash. We are earning interest on it, but I don't think anyone made their QOZ investment to earn interest. So we have to find something. Our goal is find something here, end of first quarter, early second quarter that we can redeploy this cash into. So now on our interest, Steve, we're earning about 3.5% in our money market funds, and that's adjusted. I mean, it's kind of going up each month.
Right. It's also point in time. It probably was not 3.5% or 3%.
No, it's
Q3,
steadily gone up as we've seen.
It's going to go up. It's going to go down and go up. So it'll change. Sounds
All
great.
right. Thanks for watching, everyone. If we missed anything, please let us know. Happy to answer any more questions we have here too. So thank you.
So long.
For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.